Today we're going to talk about what is the VXX. So what is the VXX, and more importantly, why do we even care? Well, first, we care because we can actually make money from it. So as an example, um, just 2 weeks ago, we sent out this trade alert buying the VXX June puts, basically a short on the VXX. And 2 weeks later, we made $1,000 or 24% return, selling out at 2.74. And this kind of looks complicated, but basically we entered the trade here at around 18.1, and we covered around 16.3 as well as 15.85. So that's how we made some money, 24%, $1,000 from this one trade. But what exactly is the VXX? And why do we care? We care because we want to make money. But the VXX is basically, it's kind of like stocks, but not really. So on the surface, it looks like a three-ticker stock symbol or four-ticker stock symbols, kind of like IBM or Apple, but it's not a company. Instead, it's actually technically an exchange-traded note. So it kind of trades like a stock, just as ETFs do. The only difference is that it's a debt instrument, but it's basically something that you can trade throughout the day from, during market hours. And the VXX is a derivative on the S&P 500 volatility. So when you look at the volatility, that's Vxx volatility term structure, they have different months. So the front month would be here on the left. So looking at this. So this April contract for the VIX structure futures would be considered the front month, and then the second month would be May. The third month would be June. So obviously it's relative to whatever your current time date is when you're watching this video. But the front month and the second month is the one that we care about. All this other stuff is not relevant to the VXX. So what the VXX does is it continually buys the second month and sells the front month. So in this table, so we have the values here. The second month, I said here, is the May contract. The front month is the April. So what you're doing is you're continually buying 12.77 and selling 11.29. So that's basically here. You're buying high and you're selling low. And of course, everybody knows to make money, you want to buy low and sell high. This is doing the exact opposite. And so what this is doing is buying high and selling low. And this term structure, this is the volatility term structure, is upward sloping, right? So the portion we care about and the one that moves the most is this front month to second month. Now, when there's kind of fear in the market, this term structure won't necessarily be sloping upwards. It could be, in the short term, it could be sloping downwards. So this 11, this front month, could jump to 16 or even 20 or even higher to 25, 30, whereas the second month would also jump up but not jump up as much, and it would be such that the front month would be higher than the second month. In that case, you would be buying low and then selling high, and then the VXX will actually go up. But as long as the market is in a complacent environment, which on the time frame of this is 2017, going back to 2009, for the past 8 years or so, the market has been relatively in a largely complacent kind of environment where this upward sloping term structure, basically the fancy word they use is called contango, right? So I have that here somewhere. But basically it's a contango environment where the term structure is upward sloping. And as long as it's upward sloping, VXX will go down, right? So that's why VXX historically looking at a multi-year chart from inception 2009 2010 all the way to 2017, this thing has gone down 99%, and every time they split adjust it such that the numbers are that you currently trade right now, on this screenshot it's 18, currently it's actually below 16, but they're going to continually kind of reverse split adjust this such that the numbers are kind of below 100. Otherwise, if it's like too high, nobody can trade it. Um, and typically when a stock goes too high, like Google, a stock goes from 100 to 1,000, it's too expensive. Usually companies split adjust it, and they adjust that 1,000 back to 100, and then give you 10 times as many shares. This is the opposite. This is a reverse split where the numbers are going too low, and in order to get people to still trade it so that it's not becoming a penny stock, they reverse split it such that the number is actually something reasonable. So historically, if you go all the way back to 2010, you're looking at something that is currently split adjusted to like the value of 30,000. Like there are no stocks that are trading at 30,000. That's ridiculous. Right now it's trading at 18, or on the chart that I'm showing is it's trading at 18, but split adjusted 6 years ago it's 30,000. And I can tell you probably in another 10 years, this where the VXX is currently trading, it's probably going to be split adjusted all the way to 30,000 as well. And what is 30,000 now? It's probably going to be like 500,000. So it's almost like no matter how much you kind of reverse split adjust this, it just continually trends towards zero. And the reason is because the VXX is just structured mathematically to kind of move towards zero as long as this term structure exists. And so because this term structure has existed for a long period of time, the VXX is continually buying high and selling low. And every time it does this, it continually does this, the performance just goes down and down and down and down. As an example, when there's fear in the market, so we take this as an example. If you look in end of June in 2016, there was the Brexit vote, and that's when the market just kind of went berserk. Volatility went through the roof, so VXX went up a lot, and you can see on this chart that it went up towards 70. But after VIX, it just dropped a lot, like dropped from 70 to 35, 50% in a matter of 2 months. When there's a rally, there's typically fear in the market. So you can think of fear in the market, before the election. Historically, in September, there's a lot of volatility. On December 31st, there's a lot of year-end selling on that last day. But everywhere else, you see red. And so this makes for a very high probability short on the VXX. And all of this is possible as long as we're in a contango environment with an upward sloping term structure for the volatility, and that's largely existed from 2009 to the present. And in a way, VXX came into inception in 2009, 2010, and so there isn't that much data kind of before that during the financial crisis, but basically after that, it's just gone kind of straight down. So I have here a kind of like a table and a chart of how VXX has performed every single year. So from Yahoo Finance, we have a chart here. In 2010, performance of VXX was minus 72%. Now, 2011, there was VXX was minus 4.5%. So VXX actually did not perform well as a short in 2011. But in 2012, minus 78%. 2013, minus 66%. Right, so we're seeing a pattern here. 3 out of the 4 years were more than a minus 60% drop in the VXX. And 2014 was minus 26%. 2015, minus 36%. And then 2016, minus 68%. In 2017, right now it's kind of end of March. In the first 3 months of 2017, it's down some 38%. So already it's much more so. It dropped much more so than it has kind of historically in that 3-month period. Now, does this mean that VXX will always go down? Well, there's a high chance. Obviously, 2011 it was almost positive, just minus 4%. It's a very small number. And so generally, if there's going to be a volatile year, you don't want to short the VXX. You might even want to be long it for short periods of time. But as a long-term strategy, this VXX strategy is really phenomenal in terms of its consistency. If you bought the S&P 500 ETF SPY and held, like, on a typical year, you might be up like some 10-15%. In some years 25%, maybe even 30%. But hey, if you took that same amount of money and you shorted this, um, yeah, some years you might be only up like a few percent, but for the most part, you could be up, over 60%, and that's just based on historical data. The next, if you're not up 60%, maybe you're up 25 or 30%, which is kind of on track with the SPY. So from a short and hold perspective, VXX is a very, very good strategy. As long as you're not seeing news like on CNBC and how the whole system is crashing and falling apart, you don't want to be short the VXX when that's happening. But when that's not happening, you do want to have some kind of short exposure on the VXX. So generally speaking, when the SPY goes up, VXX goes down, and when SPY goes down, VXX goes up. There are some cases when the SPY goes flat, and sometimes the VXX actually trends down slightly. So the analogy I think of is, VXX has, they call it like a roll yield effect, where it's like for each day that goes by, and we're in a contango environment, and you're buying high and you're selling low. You're buying that second month higher volatility, and you're selling the front month lower volatility, and you're losing value there. Each day the ETN or ETF-ish does that. It's kind of like cushion, right? So it's kind of like giving you a little bit of short value each day that happens. So the analogy I like to think of is you're kind of like in a motorboat out in the ocean, right? So the ocean, there could be storms, and that's when there's a lot of volatility. But when the water is calm, your motorboat, you can actually see progress. So your motorboat is like kind of like constantly turning, and you're moving you in one direction, right? So when there's a storm and an ocean current, that could be pushing you back. You could be losing money on your VXX short. So you could be losing money for weeks and weeks. But when the storm finally goes away, then you could start seeing progress. Your little motorboat starts making progress. You start actually moving in the direction that you want because now the ocean water is calm. And so, it might take some time because that motorboat is not moving you very far, whereas those ocean currents can really push you like miles and miles and miles. But as long as you're holding the short and the ocean waters are calm, then you're moving kind of out into the horizon. Now, you don't know when the next storm will be, but odds are it's going to be a while before the next storm. And so it's generally a good probability that you can hold on to your short, and eventually you'll kind of make some good progress. It's kind of like building Rome. You don't build it all in one day, a little bit each day. And and some people calculate this kind of roll yield effect and attribute it to something like 5 cents or 8 cents a day. Of course, that roll yield can work against you when there's elevated volatility. But when it's working for you and you're holding that position, then there's kind of like this kind of slight benefit to you that's kind of moving the VXX value down each day. And so I think that's the best analogy I could think of. Having that motorboat out in the ocean, when it's calm, you can make some progress. You just have to make small progress over a long period of time. You have to give it time to play out. But of course, in the short term, you could be down 50% on a short. That VXX value could go up very, very quickly. And that's when there's a storm happens. But once that fear goes away, once that Brexit event is gone, once that Trump fear is gone, then that VXX can really play out well on the short side. And there was a period when VXX went up for several days in a row, even when the S&P 500 was rallying. That was actually something that caught me by surprise. I expected that on a good rally, that the VXX would go down, but instead it went up. And the thing is, after it went up like 4 or 5 days in a row, something that kind of hasn't happened in the past kind of 9 months or so. That's when I alerted a VXX short via puts, and that's a trade that I show here. It was going up and up, and the thing is, it looked like we were losing money for some time, or flat for some time, even when the VXX was going down. And so, I was trying to kind of evaluate, should I short the VXX straight up on margin, or should I buy VXX puts? And, of course, I didn't want to lose money on time decay, so I bought 6 month or 5 to 6 month puts. And the thing is, at the 5 to 6 month put, I think the result is that it's roughly the same as if you shorted VXX straight up on margin. So if we put $4,400 and we put that on margin, makes that $8,800 because you double it. If you took that $8,800 and you shorted it at 18.1, and then you covered at, let's say best case 15.85, that is like a 12.5% drop. But since you margined on it, you effectively doubled that return. So that 12.5 is actually 25% return. So that's basically the same as what we got on the put. The put trade, we got 24%. So, the benefit though with the short VXX is like when the VXX goes down, you start to see profit in your account right away. So it makes you know that you're on the right track. Whereas with the put, the value doesn't really show up until later on when the VXX finally drops like precipitously. If it drops just a little bit, your account's still going to be flat. Whereas if you had the VXX short, you would actually be in the green. So generally speaking, if you want to leverage up, the VXX put can give you more returns, but you have to time it right. If you don't time it right, you could lose money. And so in this case, I gave it a 5 month put, but in reality, probably a 3 month or 2 month put would have performed, significantly better. That said, if you want to see green in your account quickly, then the straight up VXX short might be the better route. So again, the VXX in summary is an exchange traded note that trades just like a stock. What it does, it's managed by a company called Barclays. What it does is it continually buys the second month volatility VIX futures contracts, and it sells the front month. And as long as there's a complacent VIX term structure, kind of complacent market environment, which has very much been the parts from 2009 to 2017, as long as that's doing that, you're continually buying high and selling low. And for each day that you do that, you make a little bit on the short side with VXX, and the VXX value drops. Historically, we could see that VXX has been down some 60% in many years. Some years it's only down a little bit, but more than 50% of the time it's down more than 60%, each year. And so from a long-term perspective, this makes for a very high probability short opportunity that you might want to consider in addition to your kind of long SPY trade or any index fund strategy that you might be using. So I think VXX is relatively new. It came out in 2009, 2010, but it's a very esoteric product that I think it's actually worth looking into and considering for a long-term short opportunity. If you think about it, it's basically the VXX is basically a derivative play on a derivative of a derivative. So first the underlying would be the S&P 500, right? That would be your underlying. A derivative of that is volatility of the S&P 500, and that's basically what this term structure is. And then we have these futures contracts, on this volatility term structure. That's kind of like another derivative. And the fact that you're buying the second month and you're selling the front month, that's another derivative of that. And of course, if you want to add another layer, you can buy puts on that. So it's like a derivative of, it's like a derivative on a derivative of a derivative. So, you can layer this however many, layers as you want. But the point is, this VXX is a relatively good short opportunity for the long term. If you want to get some recommendations on when to enter and when to exit, make sure you sign up for our trading list. Going to the lifestyletrading101.com/sign up, and you'll be added to our WhatsApp kind of broadcast list where you can get real-time trade alerts on when to exit and when to enter. That's it for today's lesson on the VXX, and best of luck trading. I'll see you guys next time.